Chris von Lindenberg. Today's March 2nd, 2022. I want to say thank you for joining me. We're on the heels of the State of the Union address. We're also in the midst of this Russia-Ukraine conflict that's turning into a global situation. Global economies are being impacted. Our U.S. economy is being impacted. We're in market correction territory. And it's not often that I throw charts and graphs in front of people. But a couple pieces of information hit my desk through some of our strategic partners, some of our investment partners, and it was meaningful enough to me that I wanted to share it with you. So I invite you to tune in for a couple minutes and join me. I'm going to walk through a couple different slides, a slideshow, if you will, that's put together with some pieces from JP Morgan Asset Management. So bear with me. I'm going to start the slideshow, and thank you for tuning in. I hope you find this helpful. Here we are. Okay. This chart touched me. Annual returns and intra-year declines. I'm going to break this down for some of you who are looking for some clarity. The red dots are showing us the lowest point during these calendar years. Okay, and this is going back basically from 1980 to 2020. You can see intra-year declines. Now, the gray bar illustrates the rate of return that the market provided. And here we're looking at the S&P. What it's not showing us is it's not showing us how high the market may have gone during the year. Okay, it's just showing us where it finished the year. So what I'd like to point out, year to date, we're at a -10 as of the timing that this chart was compiled. And I want us to look here and realize just how many times we've already been here. So many times. This is not unusual. This is not out of the norm. Is the situation with this global event, this conflict with Russia, out of the norm? Sure, it's different this time. Well, it's always different every time. In any event, have confidence. We're nowhere near even where we saw with COVID. But the same year that COVID rocked the markets at the beginning of 2020, we still ended up emerging with a positive 16% return. When you look at some of these other years in history where there were steep declines, -49%, gosh, that's the global credit crisis. Very next year, we saw some years of recovery, but not all of which were those years significant. We had some flat years there. I'm going to cruise to the next chart. But before we do, the key takeaway, returns annually, they were positive for 32 of the last 42 years, resulted in positive returns. And we've been here, but again, we've been here before. All right, this chart I really like. Let's focus on the top one. So here, we're looking at portfolio returns for a full equity, that is a stock market-based portfolio. That's the S&P 500, 500 largest domestic, that's US-based companies by market share, compared to equity and fixed income blended portfolios. So that means stocks and bonds. Now, there are two portfolios that they're comparing it to from an asset allocation standpoint, a 40-60 and a 60-40. So in green, you can see that at the beginning of 2020, a $100,000 investment in each of those three portfolios, we experienced in that first quarter, we experienced a big hit. You can see that on March 23rd, the S&P hit a bottom. You can see that the other portfolios that had both stocks and bonds did not have the same degree of volatility. Why is that important? Well, for most of our clients, they have a mixture in some degree or another of stocks and bonds, not just all stock. And so you would expect that portfolios, if you've got a mixture of stocks and bonds, you wouldn't expect the same decline as a pure equity, a pure stock market portfolio. Now, you can see recovery periods were shorter for the portfolios with a blend when compared to the S&P. It took longer for the equity markets to fully recover. Now, at the end here, you can see that, yes, the S&P may have had a higher return for that period, but the other holdings, the other alternative portfolios did not do as bad. They didn't do that bad. The choppiness that you see in the full equity portfolio is a little more muted when you add bonds to the mix. Similar fluctuations when you see of when they've occurred, but not to the same degree. So let's get some additional meaning out of this. This bottom chart here, this illustration coincides with this top one, where you can see that for this 20-year return by asset class, using the green S&P from the top chart, the return was 7.5%. By having a mixture of stocks and bonds, just as these ratios imply, over a 20-year period, you can see that the returns by having a mixture were not that drastically different. Were they less? Yes. But it took a great degree of volatility out of the portfolio. Now, illustrated here in orange, that's not at the top, is what they refer to as the average investor. You see, the average investor historically has a track record of getting it wrong. Not every investor has access to a qualified financial professional. Not every investor allows their investment portfolio managers to do their jobs. And they try to make decisions, armchair decisions, if you will, of when to enter and exit the market. Now, market timing, when you're thinking about opportunity, can obviously mean a lot. But I think that's best left to the investment portfolio managers and not to us in our armchairs trying to figure out when do we enter or when do we pull out of the market. And a couple of charts later, we're going to see a little bit more reason as to why that's the case. So the average investor grossly underperformed. They barely outperformed inflation. But there were a couple surprises on here for me. One surprise is the negative 20-year return for commodities. That was kind of surprising to me. Didn't expect to see that there. I also didn't expect to see REITs. That's a real estate investment trust. I didn't expect to see that on the other end of the spectrum with a double-digit return. Just kind of surprising. All right, I'm going to continue to the next slide. What this slide is telling us is this is the range of a stock versus bond and blended returns in a portfolio. So you've got stocks in green, bonds in blue, and a 50-50 mix. In any 1 year period of time, if you're looking at a very short sample in the market, there is a significant degree of volatility that you could experience. You're looking at too short of a time sample. That's it. It's too short of a time sample. A little dumb luck. You could be on the top end of this, smiling to the, when you look at your statement, or you could have some anxiety looking at your statement. But when you go out for longer durations, what you see is the peaks and valleys, the averages, really smooth things out. Where when we now look long-term, stocks over a 20-year rolling period, all right, you can kind of see the upside 17% and the downside 6% over that period of time from 1950 to 21, looking at rolling 20-year periods. Bonds didn't perform too bad. Now, in recent times, they're a little tougher with low interest rates. But then the blended mix kind of fell in between. And so just keep in mind, when you look at short periods of time, it would be kind of like judging the outcome of a baseball game after a single inning, or judging or trying to guess the outcome of a series, the World Series of baseball games after just one game. We need longer time periods. And that time in the market can help reduce volatility. It smooths out the ride. All right. This chart I really like. How to explain this? If you had entered the market, all right, back in January 1st of 2002, and you stayed to the end of 2021, right? Basically a 20-year period. Had you been fully invested in the S&P 500 with a 10 grand investment, so you put it in and you ignored the news, maybe you didn't even look at your statements, but you just let it ride, just let it do its thing, the return on investment was quite considerable. Now, from the other hand, I'm going to go back to the comment about armchair decision-making. If you thought, let me try and time the market, but you made a couple mistakes and you missed out on the 10 best days in the market. So if we took that 20-year period and we eliminate the 10 best days, that return drops by over 4%, almost half. You almost half your return. It's crazy. And obviously with time and compound interest, you've got half the account value, less than half than what you would have had if you were fully invested. Now, if we increase the number of best days that we missed to 20 or 30, you start getting into that average investor return range of that earlier slide. And interestingly enough, if you missed the best 40 days out of this period of 20 years, you'd have a negative return. My gosh, so just over a month of time, you missed that time frame out of a 20-year period and you missed all the good days, you're all of a sudden in negative return territory. So let's look at the summary box together. 7 of the best 10 days happened within just 2 weeks of the 10 worst days. So what is that saying? That's saying if we go through a bad couple days in the market, a really bad day, don't make a knee-jerk reaction. Ride this thing out, because 7 out of those 10 in this time frame, 7 out of the 10 best days happened within just 2 weeks. It made a bounce back. So try not to make emotional decisions. We want to, stick in this. If your goals haven't changed, ride this thing out a little bit. Let's keep cruising. All right, index definitions. That basically concludes the slideshow here. So takeaways, where are we with this? If your goals have changed, if your financial picture has grossly changed, connect with us. Let's make sure everything's still in alignment for you. Otherwise, this, in many respects, is about opportunity. It's not about fear. It's about opportunity. The "yeah, but it's different this time" response. Anytime there's a market correction, it's different. But again, as you saw in some of those slides, we've been here before. We've been in way worse places. This is a time, stick to the long-term plan. Dollar cost average into the market. You got cash sitting on the sidelines. You can consider adding it to a portfolio if the time horizon allows. And you might ask, do I do it in a lump sum or do I break it up? Well, it really depends. It would be a judgment call, depending on your investment risk tolerance, your time horizon, how much capital we're talking about. If it's hundreds of thousands of dollars, yeah, maybe we want to break that up a little bit. And there are ways we can do that. But communicate, that's key. And I hope this communication today is something that you found helpful and valuable by going through that slideshow with me. Thank you for tuning in. Please stay safe and healthy, and hug your loved ones. And let's pray for the people of Ukraine. Thank you.